Good morning, it's Jeffrey Christian. It's 11 o'clock on Tuesday, the 23rd of November. I'm going to be talking to you a little bit about gold, silver, and update the markets. The markets are off sharply. Gold has fallen close, roughly $100 in the last couple of days. Silver's fallen sharply too, but everything else has too. We will not, just to remind you, we will not be making a video on Friday. We're taking the day off. After Thanksgiving. So we'll be back a week from today on Tuesday. I wanted to talk, really sort of respond to some of the comments that we have gotten from the last video. Last Friday, we talked about the relationship between gold and inflation and issues related to the nature of what inflation we're seeing and what to expect in terms of inflation. I got several comments, and I wanted to really key off of those comments today. And the first thing I want to do is I want to talk about what CPM Group is doing here with these videos. It's been, I guess, roughly 2 years now that we've been making videos. And the purpose and what we're trying to achieve, I guess, I wanted to talk a little bit about. And one of the reasons is that last Friday, after I did that last video, I had lunch with somebody who pointed out our January 4th, 2021 video and said, you know, it was very interesting what you said because it presaged a lot of things. So 2 days before January 6th, I used the term about, I was talking about the things that could agitate precious metals markets and prices, and I said something about how in 2 days there would be a battle royale at the US Congress. I didn't quite know that first off, there was nothing royal about it. It was pretty plebeian, but I didn't realize that it would be quite that severe of a battle because I, watching the news, was fully aware of what was going to happen, and I assumed that the Capitol Police and Metro Washington Police knew too. Anyway, what we try to do here is talk about particular salient issues related to gold or silver or precious metals or commodities in general. If we tried to give you an overview each week, it would be too long and complicated. We do what we call deep dive seminars: gold, silver, platinum group metals, other metals, commodities, investing in commodities, hedging. And those deep dive seminars can last anywhere from 4 hours to 5 days. So it's very complex markets, and our analysis is very complex. And so last Friday, for example, we talked about inflation and the relationship between inflation and gold prices. And there were several people who said, hey, inflation doesn't matter. What matters is money supply. And you're not talking about money supply. Why aren't you talking about money supply? Well, that's because we were talking about inflation. And the idea is that over time, we cover all of the salient issues and provide you some insights that help guide viewers through the markets. So that's what we're trying to do. And so if we talk about inflation 1 week, it's not that we're ignoring money supply or real GDP or the stock market or the bond market or interest rates or currency markets or other factors or the fundamentals of a gold or silver market. It's just that that's what we're talking about. Today, I'm going to talk about monetary aggregates and their relationship both to inflation and to gold. It's not that I'm ignoring everything else. That's what I want to focus on in a relatively limited period of time. So several people had said, hey, why didn't you talk about money supply? Because money supply, that's what really drives gold prices higher, and that's what drives inflation higher, except that it doesn't. Here are the statistical correlations of M1, M2, and MZM to inflation and to gold prices from 1971 till the present. And you can see the relationship between money supply and gold price and inflation have been negative. Money supply M1, narrow money supply, negative 6%. MZM, broad money supply, negative 17%. And M2 in between at negative 8%. When I was a younger person working in the economics department at Goldman Sachs, and prior to that, people would talk about the J curve. Well, the relationship between M1 changes in M1 and changes in inflation were lagged. And there was a J curve. And the J curve initially at one point people were saying was 8 months. 8 months passed and inflation didn't pick up. So then it ultimately got out to 18 months before people realized, hey, something changed in 1979, 1980, and it changed the relationship between money growth and inflation. And what happened was Paul Volcker was named chairman of the Fed, and he changed the rules of money supply growth in the United States, and he killed inflation. Also caused a large double-dip recession, but that's beside the point. So the relationship between money supply and inflation is a lot more complex than a lot of people think. Yeah, there are those dogmatists out there who will tell you that, hey, this thing's all going to collapse because this money supply is so outrageous, blah, 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 blah. And they'll just keep talking because they really, truly believe that. And they really, truly want you to buy gold and silver at high premiums because, my God, the world's going to collapse. It's quite clear. Interestingly, the relationship between money supply and gold is positive, but it is also very small. 1% growth relationship between changes in money supply M1 and changes in real gold prices, 10% and 13% for M2 and MZM. Those are not particularly high correlations. And if you look at the data charts, you can see that. You know, here, blue, M1, up and down, you know, 15%, 18%, 15%, 14%, 18%, and inflation just really hasn't been responding. I don't have a chart showing M1 and gold prices, but you can see the correlations. It's a waste of time to make those charts, unless you want to go head to head with the snake oil salesmen and dogmatists. And MZM, similarly, really big relationship, you know, 35% growth in MZM and inflation falls. You know, the relationship between money supply and gold prices, money supply and inflation is much more complex than a lot of people or some people would like you to believe. And just because we have this very high money growth doesn't necessarily mean that we're going to have high inflation at some point or that we're going to have higher gold prices because of several things in that complex relationship. One of which is, and you can see that with the periods of sharply lower money supply, the monetary authorities since 1980, 82, 83 have flooded the market with money when they need to avoid severe or more severe economic problems. And then after we're out of those problems, they sterilize the inflationary consequences by selling bonds and sopping up the excess liquidity. And they've done that repeatedly. Now, as I've said in earlier videos, this time around is different, but it's not. We have a much larger growth in M1, M2, and MZM now than we have in any of those prior periods of time. But the Fed is showing every sign that it can control this and it can sop up the excess liquidity. And as I've said in earlier videos too, inflation doesn't only come from too much money in circulation, it also comes from the real economy and the relationship between the supply and demand of various goods and services. And a lot of the inflationary pressures that we are seeing right now, some of them are definitely a reaction to the vast increase in money supply. And we'll see if the Fed continues to, as they're saying they're starting to, sop up that excess liquidity by pulling back on their bond purchasing deals. And we'll also see if the supply demand, the real economy's factors that are pushing inflation higher, if those in fact come back into line over the course of 2022 and beyond. Not sure that it is, and as some of you know and remember, we're relatively positive on gold and silver 2023, 2025, partly because of these issues. But the reality is that the relationship between money supply and inflation and money supply and gold price changes is not as clear cut as a lot of people or some people. I think the majority don't believe that, but there are people who do believe it, and they either feel compelled to tell you that the world's going to collapse, or they feel compelled to put comments on our website, on our videos. And then I used this chart last week. I just want to bring it home. Not only is the relationship between money supply and gold not all that good, the relationship between inflation and gold is not all that tight. And we've seen gold prices rise enormously over the last 2 decades in an absence of inflation. So it's other things that are going on that have been driving investors. Now, next step, a bit of clarity on silver investment inventories on the Comex. I made the comment, I ran through some data on silver inventories, and I pointed out that while they are off the registered inventories and the non-registered but eligible inventories are off from where they were in 2020 and early 2021, that they're still very high by comparison to earlier periods of time. And the Demented Uncle commented, yes, Comex inventories, blah, blah, blah. Are they encumbered? Are they hypothecated? The eligible and the registered? And the answer is no. But here's the numbers. And again, last week, what I was pointing out was, the dogmatists, again, talk about this 50 million ounce decline in registered inventories over the course of this year, but they completely ignore the 70 million ounce increase that occurred in the 6 months prior to that. And if you really want to understand what went on with the drawing down of those inventories, you have to understand how it is that we had this very steep, steeper increase in inventories in 2020, because the decline is a reaction to, or if you will, resolution of what caused a lot of those inventories to pour into the market, taking Comex registered inventories to record highs. And then this is eligible inventories, and a big part of the total increase actually was the registered. But to answer our dear Demented Uncle's questions, first off, none of the gold, silver, platinum, palladium registered with Comex or the NYMEX clearinghouses is encumbered or hypothecated. It cannot be by regulations and by the structure of the clearinghouse. Okay. Sure that somebody says, well, they'll just cheat. Yeah, that's fine. Those inventories are not hypothecated. In addition to that, one of the things that a lot of the guys on the YouTubers don't necessarily understand is that virtually none of the metal that's eligible but not registered with the clearinghouse is hypothecated either. It's the nature of what those inventories are. If you look at where metal is leased, it's primarily leased into the industrial market. And those industrial marketeers need metal. So that if I'm a fabricator, I could be a converter of bullion into plating salts. I could be a converter of bullion into sputtering targets. I can be a user of plating salts and sputtering targets, or anything else. I could be a jewelry manufacturer, electronic manufacturer, a pen manufacturer. I need the metal that I'm leasing in my factory, not in a Comex registered depository. So there is a lot of metal that's out there on lease, but it's not the metal that's in Comex depository. So dear Demented Uncle, the answer is no. Most of that metal is unencumbered. And that's important because first off, on the registered metal, it's there to meet any delivery demand that the longs might have. And on the eligible material, it's there to be registered if it's needed. There's no encumbrance on the vast majority of that. Some of it might actually be leased out or used in some financial transactions. But the vast majority of it is not leased out or otherwise hypothecated or encumbered. So it's there and it's available if the price rose, for example, or if there was a squeeze on the Comex registered silver and people have not registered but eligible material, they can deliver it on a moment's notice. So that's that answer. Let's talk a little bit about gold and silver. As I said, gold prices have fallen sharply, silver prices have fallen sharply. If you put that into the context of what we've seen over the last several years, it's not all that sharp, but it is a sharp part. We will be issuing trade recommendations on gold and silver to our clients later today. And basically, we're probably going to say stand aside. We're still longer term bullish on gold and silver for a variety of economic factors as well as fundamental factors. But in addition to that, we're a little bit concerned that there is still some downside potential. We've seen the financial markets in disarray over the last 2 days. It's not just gold and silver. It's not just commodities. Gold, silver, platinum, palladium, copper, lead, aluminum, oil, agricultural commodities. All of these things have fallen sharply. Interest rates, the yields have risen sharply. There is a view that has taken hold more broadly in the financial markets that the economy is stronger, and that does have inflationary pressures, but that the Fed, especially now that Jerome Powell has been renominated, the Fed has gotten a green light, both from the administration and also from the support on both sides of both parties in the Congress. The Fed has gotten the green light to deal with inflation. So there's this view that, yes, the economy is stronger, and that's probably going to mean higher interest rates sooner than a lot of people thought. So you saw the stock market rise sharply early yesterday, and then when the stock market realized it probably means higher interest rates, it fell sharply toward the end of the day on a valuation basis. So strong dollars, strong bond prices, strong stock market flipping over to a weaker stock market, but still at very record highs. And on the precious metal side, big declines, but within the range that we've seen really for most of this year. So that's our view. Now, there was one more comment I wanted to, somebody said, I'd love to have your thoughts on agriculturals. And we will get to agriculturals at some point. But right now, I got to run. We've got some other things to do. So I will hopefully get to the agriculturals in a future video. Again, you can go to YouTube, find out more about us. You can become a retail investor client of ours and get the gold and silver trade recommendations, other information on a monthly basis, annual yearbooks. You can buy the yearbooks separately. We will be having our yearbooks released next year in the first half. We've announced the dates, and then we're going to have 3 or 4 different seminars on platinum group metals, energy and metals markets, silver seminar in conjunction with the PDAC, and a gold seminar with the IPMI. Thank you, and have a good holiday if you're in North America. And if you're not in the United States, have a good rest of the week, and I hope you're productive.